Hello, Stephen Cruz here with MyMortgageBroker.com and Paragon Mortgages. Today, I wanted to talk a little bit about RRSPs and tax-free savings accounts. I noticed recently that there was a poll by one of the big banks, and they had said that more than 25% of Canadians have no idea the difference between a tax-free savings account and an RRSP. And I've been talking about these over the last couple of weeks, and so I want to make sure that we're all on the same page. We all understand what they are so that you can go back and watch my videos when you understand what the difference is between those two. So let me share my screen and we'll go through that together. Okay, so tax-free savings accounts versus RRSPs. So RRSP is a registered retirement savings plan, and TFSA is a tax-free savings account. So I'm going to talk a little bit about how they are the same, and then I'm going to review RRSPs, or registered retirement savings plans, and then I'll talk about tax-free savings accounts, so TFSA. So with respect to the RRSPs, the way they're similar is that they're like an umbrella. So it's not an investment that a tax-free savings account is, or RRSP, but they're both umbrellas. So you can put investments inside. You can have any kind of investments, well, many kinds of investments inside. Not everything is eligible to be in there, but many different things are certainly eligible to be in there. So like a high interest savings account, GICs, mutual funds, segregated funds, stocks, bonds, ETFs, exchange traded funds, if you don't know what an ETF is, exchange traded funds, and then other things as well. So they are a umbrella that allows your investments to grow without incurring income tax. Both of them do that. The RRSP is different than the tax-free savings account in a few key ways, and we'll talk about that next. So RRSP is a registered retirement savings plan. I've said that already. It's an umbrella, and the contribution room that you're allowed for your RRSP is based upon your income from the previous year up to a maximum. So 18% of your income from last year can be calculated so that you can deposit funds into investment funds into your RRSP, and you allow those funds to grow tax-free. When you deposit the money into the RRSP, you're going to get a tax receipt, a contribution receipt from the institution that you invest your funds with. And the tax receipt can apply to your income taxes. So if, for example, you have contribution room for $30,000 and you deposit $30,000 into your RRSP, you'll get a receipt for $30,000. And when you file your income tax returns, if let's say you made $100,000, the $30,000 will be applied to the income tax return and reduce your income from $100,000 down to $70,000. So 100 minus 30 is 70,000, and you pay income tax on 70,000 when you file your income tax return. If over the year you've been paying income tax as if you were earning 100,000, then that extra money you paid, you'll get back as a refund. And so that's how that works. However, when you go to take the money out of your RRSP, you'll be taxed on it. So you get a tax receipt for putting the money in, but you will pay tax when you take the money out. The idea is you put the money in while you're earning income, while you have while you have a higher income, and you can save on your income taxes. Let that grow tax-free, and then when you're retired, when your income's lower, you can draw the money out at a lower income tax bracket, and it benefits you. So that was what it was designed to do, and there's some strategies that I've talked about in other videos, and I will put those videos here, actually not there, but here. You can see the series that I talk about with respect to the RSP strategy. And so now let's talk about the contribution room. So the contribution room does in fact have a limit, and 18% of your income can go to a maximum. So for 2020, when I'm doing this video, the maximum contribution is $27,000. So if 18% of your income is greater than $27,000, then you cannot contribute more than that. And as you can see, every year it goes up a little bit. These are other calculations if you have a employer benefit program of some sort, when you contribute to that and your employer contributes to that, that reduces your RRSP contribution limit. And so that's what these numbers here are for. And it's really beyond the scope of this video per se, but just know that the maximum contribution is 18%. You can calculate that yourself, or you can look at your notice of assessments, and on there's a line that'll tell you exactly how much your contribution room is. All right, so let's look at tax-free savings accounts. So TFSA, or tax-free savings account, just like an RSP, has an umbrella. You can put investments in savings account, GIC, mutual funds, that sort of thing. The contribution limit is actually governed by the government, or determined by the government. They set it every single year. So for 2020, the contribution limit is $6,000. When you put your money into the tax-free savings account, you do not get a tax receipt. So it does not allow you to reduce your income, doesn't reduce your income, and therefore you don't get a tax refund because you've reduced your income by putting money into your tax-free savings account. You can withdraw the money out of your tax-free savings account tax-free because you didn't get any tax reduction by putting it in, so you don't get you don't pay any taxes by taking it out. So with respect to that, you are only allowed to do a certain amount, a maximum, and every year it's added up. You can again go into my CRA website, or it's my CRA website that actually shows you what your tax-free savings account limit is, and so you would know how much you're allowed to contribute. One of the interesting things about the tax-free savings account is if you've contributed to your max for this year, so let's say in January you've put in as much as you're allowed to put in, and then you withdraw all of the money in June, you've withdrawn it, and your room is now zero. You hasn't changed, even though you had taken the money out. But the following year, on January 1st, all of the money you took out, all the room you had that you don't have anymore, will be available to you again. So if you have an investment that does really well inside your tax-free savings account and doubles, and you could withdraw it, and that would double the contribution room you would have available. So when next year you're going to contribute to your RSP, you can take that out. Also, the downside to that is if you have an investment that tanks and decreases by half its value, and you withdraw that funds, you've now reduced your contribution limit from what it was to the amount that you've taken out of the tax-free savings account. So there's a bit of a double-edged sword there. You cannot contribute and withdraw funds in the same year unless you have contribution room to do so. So for example, if you have $10,000 of contribution room, you've got a bunch of money in there, and you put $5,000 in, that means you have $5,000 of room left. Let's say you take $10,000 out. So when you take $10,000 out, that doesn't free up $10,000 of room. You still only have $5,000. So you can put another $5,000 in that year, but you can't put 15. The following year in January, because you withdrew 10, that 10 would be increased again in that year, and then the new year's contribution limit will go up. So tax-free savings account is slightly more complicated and different than the RSP. Let's just look at the contribution limits. When it started in 2009, contribution limits were $5,000. They stayed that way for a few years, or 2 years, I guess, 3 years, and then they started increasing. So in 2015, the government gave a one-time increase of $10,000, and then they started sort of indexing to the nearest $500 every year thereafter. So in 2020, if you're 18 as of 2009, and you have never contributed to a tax-free savings account, then you would have $69,500 of room. If you weren't 18 on 2009, or if you did not live in Canada in 2009, if you moved in a subsequent year, then your tax-free savings account room would be different. It would depend on how long you've been the age of majority or how long you've lived in Canada. So that is what the difference is and how they're the same. If you like what the information that I provide on this channel, please hit that subscribe button down below and like the video so that your friends and anyone that you know will also see that. And Google really likes it when you like the videos. If you have any questions for me, please put the questions in the comments below. You can also connect with me at mymortgagebroker.com. And I'm Steve. You have a great